Picture two identical twin brothers, Ethan and Lucas. Both are 30 years old, earn $82,000 a year at the same job, live in identical homes on the same street, and drive the same dark blue sedan. On paper, their lives are financially identical, but over the next 30 years, Ethan will pay $275,000 more than Lucas for the exact same lifestyle. He doesn't lose it gambling or making reckless investments. He quietly hands it over to banks and insurers because his credit score is 645 instead of 760. This is the hidden credit tax most people never calculate. We complain about income taxes and sales taxes, but we ignore the credit tax, which quietly drains wealth from people who don't understand how the system works. Your credit score is not a measure of your character or your wealth. It's a measure of how profitable you are to lenders. In the high-interest environment of late 2025, understanding this difference can protect roughly $250,000 over your lifetime. The FICO score was introduced in 1989. Before that, humans made lending decisions, which had serious flaws. The modern system removed some human bias, but replaced it with algorithmic rigidity. Credit scoring was created to standardize risk so debt could be packaged and sold. It effectively created tiers where prime borrowers receive discounted money and subprime borrowers pay a built-in surcharge. Consider buying a $420,000 home. With a 760 score, you might qualify for a 6% mortgage rate. With a 620 score, you might be offered 7.5%. That 1.5% difference doesn't look dramatic, but over a 30-year mortgage, it adds up to about $135,000 in extra interest. Same house, same neighborhood, dramatically different lifetime cost. If that $135,000 had been invested over 30 years, it could grow to over $550,000. The true cost of poor credit isn't just higher interest, it's lost compounding and a weaker retirement future. The impact extends beyond mortgages. Auto insurers in most states use credit scores to determine premiums. Even with a spotless driving record, someone with poor credit can pay nearly double what a driver with a DUI and excellent credit pays. The system statistically favors the high-score borrower regardless of driving behavior. Landlords use credit scores, utility companies use them to set deposits, and some employers in finance, defense, and government include them in hiring decisions. A missed payment during a medical emergency years ago can affect housing or job opportunities. The score has evolved into a broad reputation metric that influences where you live, what you drive, and where you work. The most ironic part is that credit scores do not measure wealth. Someone could have $8 million in cash and no debt history and still appear unscorable. Meanwhile, someone living paycheck to paycheck but making minimum payments perfectly can have an excellent score. The system rewards participation in debt and consistent interest payments. Paying off loans early can even cause a temporary score drop because you're no longer generating profit for lenders. The formula reinforces this structure. Payment history accounts for 35% of your score. One 30-day late payment can damage your report for 7 years. Credit utilization accounts for 30%. Using $500 on a $1,000 limit equals 50% utilization and signals risk. Increasing the limit to $10,000 while still using $500 lowers utilization to 5% and boosts the score. Nothing changed except the ratio. Length of credit history makes up 15%, which is why keeping older accounts open matters. Wealthier families use the authorized user strategy. A parent with an 800 score adds their 18-year-old child to a card with 20 years of perfect history. The child inherits that payment record and can start adulthood with a 780 score. Meanwhile, someone without that advantage may face 15% interest rates on their first loan. This becomes a quiet mechanism of financial inequality. If errors appear on your credit report, the Fair Credit Reporting Act requires that all information be accurate and verifiable. If a bureau cannot verify a disputed item within 30 days, it must be removed. Many credit repair services exaggerate results, but the legal framework behind disputes is legitimate. Just as wealthy individuals use tax laws strategically, consumers can use credit laws to ensure accuracy. Some argue that avoiding credit entirely is the best solution. In theory, paying cash for everything removes dependency on lenders. In practice, most people will need a mortgage, insurance, or rental approval. Living without credit history often means higher deposits and added friction. The practical move is not to boycott the system, but to manage it strategically. Automating payments protects the 35% tied to payment history. Requesting credit limit increases every 6 months can improve the 30% utilization factor. Keeping older accounts open protects the 15% tied to account age. Disputing errors matters because 1 in 5 credit reports contains a mistake. Ultimately, your credit score is not your identity. It's a financial tool. Managed properly, it grants access to lower interest rates and prevents paying an unnecessary $275,000 premium over a lifetime. The system extracts money from disorganization and rewards structured participation. By understanding the algorithm and controlling the variables, you shift from being profitable to lenders in the short term to being trusted long term, where the lowest borrowing costs exist.